Hello, everyone. Matt Somberg, partner and co-founder of Gottfried and Somberg Wealth Management. Hope you're well. We're a few weeks into 2026, so wanted to take a minute or two, review 2025, and share with you a few of the things that we're thinking about for 2026. All right. So first, 2025 was a good year. The S&P was up 18%. The NASDAQ was up 21. Non-US stocks were like the breakout star of 2025, up 32%, which is very unusual for international stocks. And the bond market had a nice year with interest rates going down. The bond market was over 7%. Looking at this, you see international up 32. It looks fantastic. Keep in mind, last year the dollar lost a fair amount of value, and when the dollar loses value, the value of foreign currencies then go up. So that definitely provided some extra wind in the sales of international stocks. Could certainly reverse itself at any time, but nice to see all four of these indices positive for last year. In terms of the S&P being up 17.9, that's great, but that's sort of average. If we take a look at the 10-year annualized return of the S&P 500, it's actually positive 15%. So last year felt great, but in terms of how markets average over time, it was slightly above average. The Magnificent Seven, I feel like for years, these slides are talking about the Magnificent Seven, and it may be that we're sort of coming to the end of talking about the Magnificent Seven. If the S&P did 17.9 last year, only two of the Magnificent Seven, NVIDIA and Google, did better than average. Five out of the seven performed worse than the market did overall. So what's still concerning or a little unsettling about the Magnificent Seven is how much of the market it represents, but it does feel like the market has turned a bit, and we're starting to see other areas of the market perform better than the Magnificent Seven. And I think that's illustrated here. In 2023, the S&P did 26%, but of the 26%, 16 of it was the Magnificent Seven. In 2024, the S&P did 25%, 14% of that was the Magnificent Seven. Last year, the S&P did 17.9, and 8.2% of that was the Magnificent Seven. So having less of an influence in terms of its share of the market's performance. Now, 2026 is a midterm election year, and I thought it would be interesting to share some historical perspective about the midterm election years. So what you see here are the 4 years of any presidential cycle. This is not specific to this president or any specific president, but just presidential cycles in general going back to 1950. So the green diamond represents volatility, and you'll see that of the 4 years of a presidential cycle, the midterm election year has the highest volatility. The orange section is the max drawdown, meaning during the year, how much did the market drop during the year? And you can see that the midterm election year has the greatest market drops. And the navy blue is what has the market averaged over time that year. And the midterm election year is still positive, but presents the lowest average returns of the 4 years in the presidential cycle. So if we made all of our decisions based on this slide, which we wouldn't, it would lead us to believe that the year would have more volatility than the other three, greater drawdowns than the other three, and lower positive returns than the other three. That's the historical data. Definitely does not mean it's going to happen, but it's interesting. Now, why could that be? Why could that have happened at certain times? Well, these are all of the midterm elections going back to 1942. So you've got presidents from both parties there. It's not one or the other. And the two columns on the right, you'll see one says uncertainty and one says certainty. The uncertainty column is how did the market do between January 1st and the election day in a midterm election year? Like, what were the returns? And if we look at what the average return has been in the first 11 months of the year, so January up to the midterm election day, in all the midterm elections going back to 1942, the average return is positive 1%. So pretty flat. The column on the right says certainty. That is simply the period of time from election day and the next 6 months. All right. So after the results are in, how did the market then do? And over that 6-month period, the market average has been 15%. So no surprise here. We labeled the columns uncertainty when investors are unsure what's going to happen, and then certainty when there's been clarity in terms of what does Congress look like, who's in charge, how much control do they have, how much influence will the president have over Congress, So interesting. And again, we don't base all of our investment decisions, nor should you, on historical data, but it's interesting slides. Now, what stock prices should move based upon is how profitable is a particular company. That's what's supposed to influence its stock price. And right now, in early February, we're still getting the earnings results of companies from the fourth quarter of last year. How did they do? What were their earnings? And what is their guidance? Meaning, what do they think is going to happen over the next few quarters or over the next year? So if we take a look at this chart, the earnings growth for the average company in the S&P from 2024 to 2025 was 12%. All right, so they were 12% more profitable on average from 2024 to 2025. As we listen to forward-looking guidance from all of these same 500 companies, 2026 is projected out to be 14% earnings growth, which is even better than 2025. So, we have this historical data about how midterm election years are supposed to be. We have this historical data about what may or may not happen after midterm elections. But ultimately, a company's stock price is supposed to move based upon its earnings. And this data here is somewhat optimistic. Now, on the bond side of the house or the interest rate side of the house, we had 3 interest rate cuts in 2024 and 3 interest rate cuts in 2025. In theory, when interest rates go down, bond values go up, and the bond market had a good year this year, returning nearly 7%. The president has appointed a new head of the Federal Reserve. Many believe that the new head of the Federal Reserve will be even more likely to cut interest rates than Jerome Powell's predecessor. So if we take a look at where interest rates were, go back to 2024, you could find short-term interest rates, things like money market funds, paying over 5%. Today, short-term interest rates, things like money market funds, are 3.5%, 3.75%. And really, it would not be a surprise if by the end of 2026, short-term interest rates, things like money market funds, are paying closer to 3%. So could be good for borrowers if short-term and long-term interest rates go down. Might not be as great for savers when interest rates are lower. So just something to think about there as we start to think about what's going to happen in 2026. So 2025 was a good year. We'll take it. They're not all that good, but we embrace it when it happens. 2026, we've got some political happenings that could influence how the market feels. But at the same time, when we take a look at corporate earnings, quite good, and the prospect of lower interest rates, that's typically a stimulant for the economy and economic growth as well. So thanks for spending a few minutes with us. If you have any questions, feel free to reach out to the advisor on our team that you communicate with the most, and try to stay warm. And we'll be back in touch in a month or so with another update. Thanks very much.